I'd like to thank everybody for joining me today. Today, I want to talk about charitable planning, and charitable planning is just something that a lot of clients, either do or should be doing. Whether they're charitably inclined or just looking for tax deductions, charitable planning can be a great option. So as you think about this, we just want to explore what the different charitable planning options can be. As you start looking with talking to clients, a lot of clients wonder what assets they can give to charity, and many just think it's just cash. But it can be cash, it can be business interest, investment accounts, all of these. This is not an exhaustive list, but think about any assets that the client has. Those, most of those assets can be used for charitable giving. But it also depends on how we're giving. Now, I want to start from simple to a little bit more complex, but direct gifts are honestly the easiest way to give property. Now, when we're giving that direct gift, we're going to figure out what we want to give to the charity. Think about just writing a check. You give it to charity, you get a tax deduction. But I also want you to be thinking about what assets you give to charity as a direct gift. If we have a client that has an asset with a building gain, a piece of real estate, an investment account. Wouldn't it be better to give that asset that's got the appreciated gain in there to the charity? The charity can sell that tax free. And if the client wants, if it's an investment account and they want to, keep that stock, give the appreciated stock to the charity, turn around with their checkbook and go ahead and buy that stock back with the current basis. So there's some additional planning we can look at with even direct gifts. As you look at the other things that we have, a lot of clients have retirement accounts that they just don't need. They're at that point where they think, all right, I don't want to take more required minimum distributions, or I've got other assets to support me in retirement. I don't need this IRA money. If I take the IRA, it's taxable. Well, now a client can do a qualified charitable distribution. In this case, and they can do this on a year-by-year basis, they can distribute their IRA or their RMD from them to the charity. Now, they don't get a charitable deduction for this, but they don't have to include that distribution as part of their taxes. So to do this, one, we're looking at the IRA. They have to be at least 70 and a half years old. The max they can do is 105,000 per person per year. So double that for spouses they could do up to 210,000 per year. And this does count towards the required minimum distribution. So if you're working with clients that are at that point, they don't need the extra income or don't want the extra income, but the RMDs are forcing it out, this could be a good way for those individuals to pass that on to charity now, and it'll allow them to see what good that charity can do with their money. So it's just another option we want to look at. Another one is leveraging our assets. A lot of clients have underperforming assets. We can reposition that money into life insurance. Now, most people just look at life insurance with the death benefit. I like spreading this out and having this as a non-modified endowment contract. So now the client can have that cash value building in that policy for what if? What if they need it for their business? What if they want to take a trip around the world? What if they need some long-term care, in retirement? Whatever it is, they can use that money tax-free. But what I like is at death, now they can use the leverage of the death benefit to take care of their heirs and also pass on more to charity. So simple example, let's say they had 100,000 in a CD that they just feel isn't performing or they don't need. They can put that 100,000 into the life insurance. There again, use it for the what if. But at death, let's say that 100,000 bought them 500,000 of death benefit. Now they can get part of that 500,000 to their heirs. Part of that can go to the charity. So it becomes a win-win for the family and for the charity. So all of that, we can do tax-free if we want to, as we structure it properly. Now, let's get into a little bit more complex. Charitable giving plus. As we look at what that plus is, let's look at the different strategies. So the first one is a charitable gift annuity. With a charitable gift annuity, we can go ahead and transfer property to the charity today. When we transfer that to the charity, the individuals are going to get a charitable deduction. Now that's property that's been transferred to the charity. The charity can manage that property. The charity can use that property for whatever their charitable purposes are. But now the charitable giving plus. What's the plus? The plus is now our clients can get an annuity stream back from the charity every year. That can be for their lifetime, that can be for joint lifetimes. They can transfer that benefit to their kids, to their friends, whoever they want that benefit to go to. But now the charity for that set period of time is going to pay out a percentage of that gift back to our client. Now, client's not going to get 100% deduction, but this allows them, if they need extra money for retirement, transfer a apartment complex to the charity. Charity can sell it tax-free and pay that stream of income back to our client for the rest of their life. So now, the next thing we'll look at is a charitable remainder trust. Charitable remainder trusts have been around for a long, long time, but it sets up very similar to the charitable gift annuity, except we're not going to transfer the property to the charity now. We're going to transfer that into a charitable trust that is designed and can be managed as trustees by our clients, by the donors. Charitable trust is set up the right way. Now let's take and say it's an apartment complex. We transfer that property to the charitable trust today. Our clients are going to get a charitable deduction. Typically, that's a large deduction. They'll have at least 6 tax returns, to use up that deduction. But the beauty of that is now they can take that property, they can sell it tax-free inside the charitable remainder trust and reinvest in those proceeds into a liquid portfolio, an investment portfolio, whatever assets they want that to be. And now as we're reinvesting those assets, we're going to have it set up so our clients receive an annuity stream of whatever percentage we set up for their life, for their joint life, for a set number of years. But now our client gets to determine how that money's invested, have a little bit more control over it. After our clients, if it's set up for joint lifetimes, after they both pass away, whatever's left in the charitable trust will go to the charity that we picked. That can be one charity, multiple charities. It could be a donor advised fund if we want it to be. But our clients now can get the assets they need for retirement. They can defer those taxes by putting it into the charitable remainder trust and selling it tax-free, and have the income that they need to live on through the rest of their life. And if we're giving money away to charity, this is one where if the kids, if we are, mom and dad want to take care of their kids, we can get an insurance policy and use that death benefit to replace that asset back to the kids. So now it's a win for the parents, win for the charity. Now it's a win for the kids because they get a tax-free death benefit upon mom and dad's death. Now, the next one is a charitable lead trust. With a charitable lead trust, where I use this is think about the sale has already happened. Our clients have a large taxable gain already set in motion that they're going to have to pay tax on. Now we can transfer property to the charitable trust. When they do that, we're going to create there again a large charitable deduction, 6 tax returns to use up the deduction. Now they can reinvest those proceeds inside the trust. Now, the charitable lead trust is not a tax-free environment. So in most cases, our clients are going to be responsible on a K-1 to pick up any taxable gains or ordinary income from the investments happening inside of the charitable trust. But now what happens in this case is the plus is there's going to be an annuity stream paid out to the charity for a set number of years, 5 years, 10 years, 15 years. At the end of that trust term, whatever's left in the trust is going to revert back to our clients so that they can use that for their retirement, giving it to family, whatever they need. So if you think about charitable planning, there's a lot more options available for our clients. They just need to know what they can do and see what fits. I appreciate everybody getting on, and we'll talk again next week. Thank you.